Dear investors, welcome to yet another episode of our podcast. If you see today, we have been hearing time and again that India's story is running ripe and is very much decoupled from the rest of the world. So let's look at what this really means and whether, are we really decoupled in what shape or form? Or is the global market really going to impact our market as well going forward? So we'll divided into two halves. One is what's working for us and what's not working for us. And then we come to a conclusion whether India is really decoupled or not with the global world. So if you look at inflation, which is a big problem for the global world, it's not such a big problem for India. It's more benign than what we see in the rest of the world. So we don't expect RBI to tighten into restrictive territory and sacrifice domestic demand in the process. They will have to do, and that will be to follow what other central bankers are doing and also ensure that inflation expectations are kind of controlled. So to that extent, what we've seen so far, if you look at the increase in interest rates by various global central banks have been in the range of 2 to 4%. What India has done is close to 1.9. There are some central banks who are lower than us as well this year, YTD. And there are certain central banks which are significantly high, like Mexico, Poland, Colombia, which have done around 6, 7% of interest rate increases. Similarly, it also reflects in bond yields in various markets. So if you look at Indian bond yields, YTD, the 10-year government bond has increased only by 0.9% as against to, for example, US, which has increased by 2.2%, and many other economies have seen larger increases in their bond yields. So India, to that extent, is kind of sheltered from a runaway increase in interest rates and also the increase in bond yields, which reflects in the borrowing cost in the markets. So while inflation in India has likely peaked, there is still a risk from a renewed rise in oil prices, which could ignite the inflation pressures. Weaker rupee can also result in imported inflation and capital outflows. India's external debt is limited. We are not leveraged. So that's a good sign for India. So that will have lesser impact on of our markets of the global increase in interest rates. So there is no debt crisis, no rating downgrades on account of weaker rupee. There is limited signs of misallocation of capital or overheating in the Indian economy per se. So if you look at the factors that determine the macro stability of any economy, so if you look at CPI inflation, we are almost in line with where other economies are. We are at close to 7% on the CPI. But if you were to look at the 12-month change in CPI, ours has been increased by 1.7%, whereas other economies like, for example, emerging markets, Indonesia, Korea, Malaysia, Philippines, they have seen around between 2 to 3% of increases in their CPI. So from a relative change in CPI or inflation, we have not seen a big jump. Also, if you look at other areas of stability, like, for example, financial stability, the total debt as a percentage of GDP is, if you look at the non-financial debt change since 2007, we have only seen about 12% change since then, whereas other economies have seen significant jump in their external, in their overall debt positions that prevail in those economies. If you look at the non-performing loans, etc., we are all very much in line with where other economies are, slightly higher than that. But if you look at the loan growth as a percentage of nominal GDP, it's not a significant increase that we have seen there. Most of the economies do not have that big problem in terms of loan growth, and nor does India have. So if you look at currency, currency is depreciating because the dollar is more stronger. We are in an environment where we've seen big strength in dollar because the yields in the US markets have increased significantly. And therefore, given the uncertainty, money is moving back to the US markets. And it's not because of our internal imbalances or excesses or weaknesses. It is more about the dollar strength. That is where we see the rupee depreciation coming from. Also, this is best reflected in the fact that our trade weighted exchange rate has been relatively stable. If you looked at past cycles where we saw big depreciation in the rupee, where we also saw the trade weighted exchange rate decline significantly. For example, in 1997 cycle, we saw a decline of about 40%. In the 2013 cycle, we saw about 12%. But in this cycle, on a trade weighted exchange rate basis, we have seen a decline of only 1%. So currency on a relative basis has been much stable. So we are not losing much in terms of our competitiveness there. So demand has been holding well in our economy despite inflation, which is again a positive sign. If you look at September GST collections, the gross revenue crosses 1.4 lakh crore mark for the seventh month in a row. India's growth differential, which has been a pull factor to attract capital with developed markets, with makeup or the narrowing interest rate differential, which has been the push factor, and therefore be able to attract capital from overseas investors. Compared to a slowing global economy, the Indian economy is doing pretty good owing to reforms, the government's investment push, and the sheer fact that we have a very large domestic market. India's ability to reap benefits amid rising geopolitical risk, particularly from the shift in globalization patterns, which has seen Western companies take their supply chains away from China. The China plus one strategy that started and then followed by Europe plus one strategy is working well for India given the stability that it offers. So we also have adequate foreign exchange buffers for policymakers to step in and manage the situation should market conditions volatile. So if you look at our import cover ratio, which is closer to now 8 months of import cover, which is better than many of the other emerging markets, which have import cover largely lying between 4 to 7%. So we are slightly better than that. And if you look at FX reserves to short-term external debt ratios, which also suggest whether you have enough forex reserves or not, that is also much better than many of the emerging market economies, which stands at 4.1, and many of them are hovering around 2.5 kind of levels. So that suggests that our forex reserves are better. The main anchor for RBI's policy reaction will be domestic growth and inflation trajectory. India appears less vulnerable than many other countries given the size of its domestic market, the stability it offers, and therefore be able to attract and retain capital. Unlikely that India will have to hike aggressively and disruptively like what we saw in 2013. So that's all positive. Now, what's not working for India? So if you look at prompted by the lower than expected GDP growth in the April to June quarter, the RBI had to revise the current year FY23 growth forecast to 7% from 7.2%. The inflation forecast of 6.7% for the current financial year has also been retained, despite a sharp drop in international crude prices that we have seen. So crude prices were in the band of 100, 110, have fallen to around somewhere between $80 to $90. Still, despite that sharp fall, RBI has chosen to maintain their inflation forecast. So the priority for central banks are very clear. Managing inflation and external sector pressures will now take precedence over growth. India's current account deficit in April-June was at $23.9 billion. This was much higher than $13.4 billion that we saw in January to March 22. So that's a sign of deterioration on the external sector. India has been facing upward pressure on its import bill since the beginning of 2022 because of what we saw is disruption on the supply side because of the Russia-Ukraine conflict. So overall, India has to be cognizant of what the US Fed is doing, and we cannot ignore the Fed. The optimism on domestic growth could get tested by transmission risk posed by global events on the trade and financial market front. So what we say about decoupling, we are still very much coupled or be impacted at least by the trade and what happens in financial markets globally. The RBI also has flagged external factors as the biggest challenge to it this year, second only to inflation. So let's look at on the trade front. The US and European economies are the biggest markets for India's exports. We export close to 30% of our GDP. Economists are expecting exports to drag domestic growth this year, given the recession expected in these two regions. So earlier, exports were a big factor for driving growth. Now we have seen, because of the weaknesses in global markets or developed markets, this could be a drag on growth. The RBI cannot respond to endangered economic growth at a time when its focus is on inflation. That ties its hands on measures related to liquidity and even cost of liquidity. So trade front, it could be an impact on India from a GDP perspective as well. Second impact that we see from a global market relations is financial market front. Financial markets are integrated still, and spillovers from one to another is inevitable. Already, investors have become worried that the UK financial institutions' trouble would spill over to the US, thus driving investors to hold cash. Capital flight is the single biggest risk for the economy, and the RBI can do little to turn the tide in the short term. So, from a valuation perspective as well, India is trading at a premium to emerging markets, a premium that we have not seen over last decade. So given that fact, it also adds to the risk if there is a pull out from emerging markets because yields are increasing in the US, that could also pull out money from Indian markets as well. So FPA outflows, if you see, in India touched 1.7 lakh crore in 2022 so far. So what seemed like a sign of change in direction that's kind of dashed in the month of September. So August saw 56,521 crores of inflows. September, again, we have come back to outflows. We saw outflows of 3,955 crores. The challenge for the central bank is to keep borrowing cost at a level that does not crimp investment demand. So it is abundantly clear that the limited measures the RBI can take to mitigate these spillovers are related to exchange rate only. In 2008 and 2013, the RBI could limit the damage of global spillovers only up to a point. And if you see, RBI's measures on liquidity and rates were part of a globally synchronized easing. It was all moving in sync, all central banks cutting interest rates, infusing liquidity. That playbook is unlikely to work now since central banks world over, including the RBI, are fighting inflation. The 2013 way of attracting dollar inflows through expats and other relaxations may work, but that also is limited to up to a point because there is a cost associated with that. The odds of India's economy delivering are still reasonable, but reducing. India's takeoff hinges on advanced economies having a soft landing. For investors, it would be wise to monitor the risk globally and tone down on recent optimism, at least in the near term. Overall, India macro story looks good. It's strong. It's on the ground activity picking up, translating into revenues and earnings for companies, but it is not completely decoupled with the global world. Hence, diversification is the key. Having a sizable allocation to equities, given the India growth story still intact, is paramount, or it's good from a portfolio perspective. But don't miss out on the protection and diversification. So, from a protection perspective, say if something goes wrong, you still need to have a kitty kept aside. So, like we advocate in the 12, 20, 80 allocation, that you need to have 12 months of expenses at a minimum kept aside, very, very safe. And any money after that split between 80, 20, 80 to equities and 20 to gold. Gold because, it will help to diversify portfolio risk. We've seen time and again when equity markets have not fared well, gold gets bid globally and therefore starts rising in value. So overall, have a large allocation to equities. Equities look prime given the India being on the cusp of economic revival, and that it's likely to run at least for next 2 to 3 years. So have a larger allocation to equities, but don't forget to diversify and protect your allocation by keeping certain funds very, very safe and diversification into gold. With that, I'm signing off now. We'll catch up next month. Until then, happy investing. Thank you.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.